You know the right thing to do. You have the rules. You have the stop loss. You have the position size. You have spent months, maybe years, building a system that works. And then the loss comes. The one where the number on the screen stops being a number and starts being a threat. And in that moment, everything you know disappears. Not because you forgot it, because your brain will not let you use it. This is the part of trading nobody prepares for. Not the strategy, not the math, the moment when the system meets the survival instinct and the survival instinct wins. This is crisis management for systematic trading. This will help you understand what happens inside the brain when capital is at risk, why intelligent traders destroy themselves under pressure, and how to build protocols that function when you cannot. We will approach this through neuroscience, behavioral finance, and real case studies. My name is Ashim Nandi. I am a system architect with 10 years of experience between running an IT company and full-time trading. In both fields, I have observed the same pattern. The most reliable system in the world is useless if the person running it overrides it at the worst possible moment. Here are the chapters that will help you understand this concept better. First, the biology of crisis. You will understand what physically happens inside the brain and body when capital is at risk and why willpower alone cannot overcome it. Second, the anatomy of destruction. You will see exactly how intelligent, experienced traders destroyed themselves and the specific behavioral patterns that repeat every time. Third, the crisis protocol. You will have a systematic framework for navigating drawdowns, built from the principles of those who survived when others did not. Once you go through all of these concepts, you will stop seeing drawdowns as failures and start seeing them as the moments where real edge is built. And with that understanding, you will also see why the traders who have survived crisis are not the ones with the best strategies. They are the ones with the best protocols. Think in odds. Act with discipline. Chapter 1. The biology of crisis. That moment when knowledge disappears under pressure. It is not weakness. It is not lack of discipline. It is neuroscience. John Queris was the derivatives trader on Wall Street before becoming a neuroscientist at Cambridge University. He spent years studying the hormonal responses of traders in real time on live trading floors. What he found changes everything about how we understand trading performance. When a trader wins, testosterone rises. Elevated testosterone increases confidence, sharpens focus, and speeds reaction time. Initially, this is beneficial. The problem is the cycle becomes self-reinforcing. Success produces testosterone. Testosterone increases risk appetite. Increased risk-taking produces more success. More success produces more testosterone. This is called the winner effect. It has been documented across species. Winners emerging from contests with elevated testosterone, which makes them more likely to win subsequent contests. In trading, it manifests as progressively larger position sizes, reduced hedging, and the quiet conviction that you have figured out the market until the regime changes and the cycle reverses. When a trader loses, cortisol floods the system. Cortisol is a primary stress hormone. Here is a timeline that matters. In the first 10 minutes, adrenaline surges, alertness increases, reaction sharpens. This is the fight or flight response, and in short bursts, it can be useful. Between 10 and 60 minutes, cortisol begins rising. Anxiety builds. Focus narrows. the trader starts seeing threats everywhere. After 60 minutes of sustained stress, the deeper effects begin. The prefrontal cortex, the part of the brain responsible for planning, impulse control, and rational analysis, loses approximately 40% of its function. Meanwhile, the amygdala, the brain's fear center, increases its reactivity by approximately 30%. What does this actually mean for a trader? For you, the rational brain gets quieter. The emotional brain gets louder. The capacity to think through probability, to weigh options, to follow a trading plan degrades precisely when it's needed most. And the capacity to panic, to revenge trade, to double down, to abandon systems amplifies. The brain responds to a margin call the same way it responds to a physical threat. This is not a metaphor. University College London confirmed through neuroimaging that financial losses activate the same neural regions as physical danger. The body cannot tell the difference between a losing trade and a predator. This is precisely why knowing the right thing to do is not enough. Under cortisol, the brain loses access to the knowledge. A trader who has survived 3 drawdowns before may be unable to recall those experiences under acute stress because chronically elevated cortisol reduces hippocampal function, the brain region responsible for memory and context. Now notice what this means for everything we have built in these principles of trading series so far. Risk management, position size, expected value, volatility adjustment. All of it lives in the prefrontal cortex. All of it requires the rational brain to function. And under crisis, that is exactly what shuts down. Now you understand the biology behind it. The brain is not designed for financial uncertainty. It is designed for immediate physical threats. But what actually happens when these biological forces take control of a real trader with real capital? That is what the case studies give us. Chapter 2. The Anatomy of Destruction. 3 case studies. Each one demonstrates a different failure mode. Together, they reveal the complete anatomy of how trading crises unfold. Case study 1. The doubling down. Nick Leeson was assigned to a low-risk arbitrage desk in Singapore. His job was to exploit tiny price differences between identical futures contracts on 2 exchanges, near zero risk by design. But he began taking unauthorized, speculative positions, hiding losses in a secret account. Here's a behavioral pattern. The first loss was small. Rather than accepting it, he added to the position. The market moved further against him. He added more. Each additional position was an attempt to lower the average entry price and recover faster. This is the gambler's fallacy applied for trading. The belief is that the market owes you a recovery because you have already suffered. Then on January 17, 1995, a 7.2 magnitude earthquake struck Kobe, Japan. The Nikkei crashed. Leeson's losses, already substantial, became catastrophic. But even then, he did not stop. He continued adding to losing positions in the belief that the market had to bounce. Total losses, £1.4 billion. More than double the bank's available capital. A 233 years old institution destroyed by one behavioral pattern. Doubling down on losses. Case study 2. The model failure. Long-term capital management. If Leeson represents the rogue trader, LTCM represents the opposite extreme. These were the most sophisticated minds in finance. Nobel laureates, former Federal Reserve officials, mathematical models that had been validated across years of data. Their strategy was relative value arbitrage, small pricing discrepancies between related securities, amplified through leverage, 30-1 on the balance sheet, approximately 300-1 including derivatives, $125 billion in assets on $4 billion of capital. The models used 5 years of historical data, but they had never seen a sovereign debt default like Russia's. They assumed that correlations remained stable during stress. In reality, when Russia defaulted, every market moved together. Diversification disappeared, liquidity vanished, and leverage amplified every loss. In 1 month, they lost 44% of their capital, $2.1 billion. The Federal Reserve organized an emergency bailout from 14 banks to prevent systematic contagion. The lesson is that models describe normal conditions. Crises, by definition, are not normal, and leverage transforms the abnormal into the catastrophic. Bill Wong had already been convicted of insider trading and banned from trading in Hong Kong. He restructured as a family office to avoid regulatory disclosure requirements. Between March 2020 and March 2021, he grew from $1.5 billion to $36 billion in value, using total return swaps that gave him synthetic exposure without owning the underlying stocks. The leverage was 5-1, sometimes 20-1. He dealt with multiple banks, none of which knew about his positions with the others. When Viacom CBS dropped 20% after announcing a stock offering, margin calls came from every bank simultaneously. Wong refused to liquidate. He believed the positions would recover. $20 billion evaporated in 48 hours. Notice the testosterone cycle. A year of extraordinary returns, growing conviction that the positions were right, increasing leverage, refusal to accept evidence of regime changes. This is the winner effect taken to its biological extreme. Goldman Sachs acted first and lost the least. Credit Suisse hesitated and lost $5.5 billion. Speed of response during crisis is not a luxury. It is survival. The common pattern: 3 different decades, 3 different strategies, 3 different levels of sophistication. The pattern is identical every single time. Stage 1. Confidence builds. Positions grow. Risk controls feel unnecessary because everything is working. Stage 2. A crack appears. An unexpected loss. The trader believes it is temporary. They maintain or increases positions. Stage 3. The crack widens. Losses accelerate. The biological stress response activates. The prefrontal cortex starts losing function. The amygdala starts gaining control. Stage 4. The crisis point. The trader either doubles down chasing recovery or freezes entirely, unable to act, or panics and exits everything at the worst possible price. Stage 5. Destruction or survival, determined not by intelligence, not by strategy, but by whether pre-established protocols existed and were followed. You now understand the biology and you have seen the pattern in real cases. Now the question is, what prevents it from having a protocol that works when the rational brain does not? That is what the crisis framework gives us. Chapter 3. The Crisis Protocol. Paul Tudor Jones made 62% returns in 1987, the year of the worst single-day crash in stock market history. While everyone else was being destroyed, he was positioned to profit, not because he predicted the crash, but he was prepared for it. His philosophy distills to one line: the most important rule of trading is play great defense, not great offense. Jones studied the 1929 crash before 1987 happened. He mapped the pattern, he positioned accordingly, and he had a rule that he follows to this day. Every day, he assumes every position he has is wrong. This assumption is not pessimism. It is protocol. It forces preparation. He also said something that connects directly to the neuroscience. I know that to be successful, I have to be frightened. Not paralyzed, frightened. Because fear, in controlled doses, is the antidote to the testosterone cycle. It prevents the overconfidence that destroyed Leeson, LTCM, and Archegos. Jones prefers hiring traders who have previously lost everything because the experience of near destruction makes risk management absolute. You cannot teach that through theory. It must be experienced, or it must be built into protocol before the crisis arrives. The central insight from all the research is this: crisis management must be established before the crisis. Under cortisol, the brain cannot create new protocols. Everything must be pre-programmed. Drawdown thresholds. At 10% from peak equity, review all positions and verify execution quality. This is the early warning. At 15%, reduce all position sizes by 50%. No discretion. At 20%, stop trading entirely and conduct a full strategy review. At 25%, seek external review and consider whether the strategy has lost its edge. These numbers are not arbitrary. They are calibrated to the recovery mathematics we covered in the first video of this series. A 10% loss requires 11% to recover. Manageable. A 20% loss requires 25%. Difficult. A 50% loss requires 100%. The account has to double. The thresholds exist to prevent reaching the zone where recovery becomes mathematically impractical. The real-time protocol. When a significant loss occurs, the first rule is the 24-hour rule. No major position changes within 24 hours. The neurochemical cascade, adrenaline to cortisol, to impaired prefrontal function requires approximately 1 full day to normalize. Decisions made during acute stress are statistically the worst decisions a trader will ever make. The second rule is the 3-minute protocol. When a trade moves against you and the emotional responses activate, 3 minutes. Minute 1, close eyes. Controlled breathing. This psychologically resets amygdala activation. Minute 2, reread the original trade thesis. No new inputs, no market watching, just the original plan. Minute 3, execute the pre-planned action. No improvisation, no exceptions. The third rule is anti-martingale sizing. After 3 consecutive losses, cut position size in half. This is Paul Tudor Jones' rule. Trade your smallest when trading your worst. Scale up cautiously when trading well. This directly counteracts the biological impulse to double down after losses. The recovery framework. Recovery is not a single event. It is a phased process. Phase 1. Stabilization. Weeks 1 through 4. Minimum position sizes only. Focus exclusively on the highest probability setup. The goal is not profit. The goal is rebuilding confidence through small, consistent executions. No strategy modifications during this phase. Phase 2. Gradual scaling. Months 2 through 3. Increase position sizes by 25% increments. Monitor closely for behavioral regression. Any deviation from protocol returns to phase 1. Phase 3. Full deployment. Month 4 and beyond. Return to normal sizing only after 3 consecutive months of consistent execution and emotional stability. Notice the discipline required. 3 to 4 months of reduced activity for a trader who is already stressed, who already feels behind, who already wants to recover quickly. This patience is the hardest thing in the world, but the math demands it. Compounding cannot begin from a deflated base without first stabilizing. The deeper truth: Here is what makes this framework different from a set of rules. Rules tell you what to do. Protocol tells you what to do when you cannot think clearly enough to follow rules. Automated hard stops that cannot be overridden during market hours. Daily loss limits that lock the trading platform. Portfolio heat caps that prevent new positions regardless of setup quality. A trading journal that documents emotional state, not just trade results. These are not the restrictions. They are the individual trader's equivalent of institutional risk management. Barings Bank had no separation of duties. LTCM had no leverage limits calibrated to tail risk. Archegos had no cross-institutional exposure monitoring. Each missing safeguard created the space for destruction. For the individual trader, the principle is the same. Every safeguard you do not build is a space where the biological stress response can take control. Strategies work partly because many traders abandon them at the worst possible time. Maintaining discipline through drawdowns captures the edge the others surrender. It is not the trading system that fails the trader. It is the trader that fails the trading system. Crisis management is not a separate skill from trading. It is the integration point where every concept in this Principles of Trading series converges under maximum pressure. Risk management defines survival. Position sizing defines growth. Expected value defines edge. Volatility defines adaptation. Liquidity defines execution. Market structure reads current state. Market regimes identify environment. Technical analysis interprets price. Fundamental analysis interprets value. Probability and statistics gives us the language of uncertainty. Strategy design builds the vehicle. Edge development gives it fuel. And crisis management tests whether the entire system holds when biology fights mathematics. The traders who survived 1995, 1998, 2008, 2020, and 2021 share one characteristic: not intelligence, not strategy, not prediction. They had protocols that functioned when they could not. Build your crisis management protocol before you need them. If you found this valuable, share it with someone who may need it too. We are building a community of traders who choose probability over ego and discipline over impulse. Think in odds. Act with discipline. See you in the next one.